talking beforehand, and I asked Charlotte what I should ask my panelists, and she said, well, you know, on the spectrum from BS to reality, where are we? So, okay, that's the perfect question. So Andrew, BS to reality.
We're halfway right now between BS and where we need to be. Think 15 years ago, every company was saying we're doing better, we're emitting less carbon. Now, 15 years ago, we didn't even have a way of measuring carbon emissions, and that's why we created the Greenhouse Gas Protocol. What's happened more recently is we've moved from I'm doing better to I'm doing enough. And this is an incredibly important transition. Now, not many companies yet are doing enough, but 530 major international companies have now signed up to what's called the science-based targets, which means we are committed to be fully transparent year after year after year. We have a target for total decarbonization through our entire supply chain by sort of the 2060 period, and invite in the World Resources Institute, WWF, CDP, for example, each year to sort of check up on them. So that's just a small fraction, but it's a very important transition. And the question is, why are these companies doing it? No one's telling them to do it. And there are lots of reasons. And one of them is the theme of today, which is financial markets are slowly starting to get it, and we should unpack that more, I think. Another is there's been just a remarkable intellectual revolution that's gone on in the last 6 to 8 years. I mean, 10 years ago, we believed you could act on climate change, but it would hurt your growth.
Yes.
5 years ago, we believed you could act on climate change and actually you could still grow. We now know you can only have long-term sustainable growth if you act on climate change. And the reason for this, and you know, the Global Commission on the Economy and Climate, which we've been heavily involved in, has been over the last 5 years working on exactly this issue. And the question is, why do we now have a different understanding? If you act smartly on climate change, you will use resources more efficiently.
I'm going to come back to you on that. And Matthew, you talk to clients of all sorts of sizes and shapes. BS to reality, what's your sort of impressionistic feeling over the last several years? Has there been this change?
It is a difficult question to answer, and I think I'm going to disagree just a little bit to your comment that we're halfway there, because I don't think there's an end to hit here. I think this is something a journey we're going to have to be on. I think there's a lot of organizations that are up to their neck in it and are talking about climate finance or talking about green finance because it's cool, or not even that, it's essential. Employees, clients, investors are all about it, so how can you talk about it? I do think there is a large swath that is trying to do this authentically and trying to take it seriously and trying to make a difference. And I think that your point about sort of a big change is actually real. I think that where we are today is very different than where we were 24 months ago, and I think it is a journey we're going to continue to be on.
So Leslie, tell us just very briefly what Acumen do, and then you can maybe tell us what your viewpoint is on that question.
Yeah, I'm happy to. So we're here to talk about divestment a bit, and the contrary to that, of course, is investment. And when we talk about, is divestment going to affect developing communities, developing peoples? And the question is, who are they? How many are there? What is that market like? Well, for the first time ever last year, we reached less than 1 billion people were without energy access. It was a huge gain. I mean, we're talking about progress. So about 980 million people currently live without energy access. And what we're trying to do and we're trying to think about is how can we fund startups, innovative startups that are serving the poor in East Africa, West Africa, India, Pakistan, those that don't have energy access. And you might say, is that possible? I mean, we're talking about poor customers. How can they possibly, how could there be business models built for the poor? Well, of the 800 million people that have gained energy access in the last 10 years, 45% have gained energy access from path-breaking startups. So there's a there there. I mean, there's something. And to the points raised, I mean, how can we get there faster? And if the end game is universal energy access, we can get there. And $6 trillion of divested funds was how much in funding was divested. If we took half of 1% of that $6 trillion, that would be universal energy access sorted through 2030. I mean,
so we've
problem solved.
We've had 800 million, you said, in the last, sorry, how long?
10 years.
10 years, and then that's about the number that's left. So that's sort of a 50-50 number, actually.
That's progress.
Yeah.
That's absolutely
But it's sort of, it's a different metric, but it's kind of Andrew's 50-50 point that...
the needle's moving.
Yeah, okay.
The needle's moving.
So there's no connection in the minds of investors, particularly between like I have to divest from coal or I have to divest from the dirtiest forms of, the most polluting types of energy production, maybe for defensive reasons, maybe because I think I have to do good, maybe because people are insisting, and then thinking, well, that means there are people who are never going to get on the grid. Is there any way of making that connection in people's minds so that there can be a sort of a smoother transition from like what I don't do to what I do have to do?
So it's not quid pro quo sort of situation. It's not we divest from coal in emerging markets and we can invest in energy access solutions. That's where the role of philanthropy is real. I mean, there still needs to be this movement to fill that gap, to prove that this is a market-based solution that can work. For now, there's still a gap for that patient capital that's needed. The returns are not going to happen in 3 years. We're talking 10 years, 12 years, but we're starting to see more and more. I mean, this is becoming a sector. 5 years ago, about $50 million was in the energy access sector. It grew sixfold in the last 5 years. So it's getting there, but we need more exits. We need to see more market activity to really say that there's a market opportunity there in energy access.
Matthew, are you seeing clients shifting from coming into you to say what they don't want to do to what they do want to do?
Absolutely. I think that what you don't want to do is sort of a starting point for many of our clients. Our clients, and one of the conversations we really have with them, is about thinking holistically about risk, return, and portfolio characteristics as they seek to invest, and really trying to be clear about what they want to achieve as they think about the path to go down. So as they think about integrating environment and social governance characteristics, as they think about perhaps avoiding or perhaps leaning into the topics that they care the most about, whether that's climate or social issues or many other, we're definitely seeing a trend towards a more proactive approach to it.
So would people be open to, if you were to say to them, you're saying that you want to get out of these things, like, have you thought what that means you should get into? Like, is that the sort of conversation?
That is definitely part of the conversation, and I think it's, again, about having trusted advisors and trying to take a step back and try to be thoughtful about what it is that you want to achieve with your portfolio, with your dollars. There's not necessarily a one-to-one translation of take from here and put here,
sure.
Because there's a lot of complex considerations that go as part of that decision making. But it's definitely a part of the conversation that we're having at an increased level with whether they're individual investors or some of the biggest institutions in the world.
So Andrew, you said you were 50-50 basically on the grounds that there's been a lot of movement and that some very big players have committed themselves to some very challenging targets. But I mean, people are always committing themselves to targets and not hitting them. So why do you feel these targets are meaningful, and why do you feel that there's a momentum in that direction that more people might join them?
2 reasons. One, we can now measure much better. I mean, we can see, for example, virtually every tree in the world falling every week. We can tell Unilever that of the 800 palm oil mills that it buys from in Southeast Asia, we can tell them that the 100 that are dishonorable and actually behaving badly. So we can now, we and many others.
Who's this we? Who's the we that can do that?
Well, in that particular case, we run this thing called Global Forest Watch. That's just one small example, but so too on greenhouse gas emissions. I mean, we now can actually measure it. So that's one reason. But I think the other reason is that it sort of makes sense. In other words, it's good for the companies to do that.
And do they really believe that?
Well, some of them do.
Yeah.
And I think that's one of the amazing sort of new pieces of evidence that's come out. I mean, even 5 years ago, the vast majority of portfolio managers would say, look, if you limit yourself to a certain segment of the sort of eligible stocks, you will reduce the yield. So even the board of the World Resources Institute, and we're the gold standard in this stuff. We're really good, and our board members are that. I mean, even our finance committee, 5 years ago, was saying, actually, our job as a finance committee is to make money, and then my job is to spend it. We now know that actually, if instead of sort of having, let's say there are 1,000 stocks that you can pick from, suppose you limit it to the 400 stocks that have reasonably good ESG ratings. The traditional way would be, you're going to give up yield. Actually, the new economics, which is clearly out there in the empirical literature, is that these 400 will do better over the longer term. And this is an amazing revolution. So I don't know whether Jim Harmon, my chair, is here because he sort of led this. We have a small endowment of $40 million. And we weren't allocating any of that to things that we stand for. Now we're allocating all of it. Why? And our yields are going up. And because we have guys like David Blood of Generation Capital, who's our co-chair as well. So we have a lot of people in my space that are giving us this data. But it's a huge revolution that's actually going on.
Matthew, are you hearing this sort of passion from people who come in and say, we thought we had to make money and then spend it, but now we want to make money the way that we, in accordance with our values as well?
Absolutely, and I know that's a topic that's been hit on hard, this idea of trade-offs and being able to align mission and investments, and I think there's so much empirical evidence out there, but for many people it still becomes a blind spot. Oh, I need more data, or I need more information, which is, kind of BS, to use a term from before. And so we are absolutely seeing this. I think that there's, I wouldn't call it an awakening, but I think that it's becoming a much more frequent part of conversations with endowments, mission-aligned institutions, individuals, family offices, right across that. We've talked a lot about them today. Millennials, which I know was hit on hard earlier. These groups are starting to say, why can't I? And understanding that the data's out there, and it all comes back to a thoughtful approach, right? Taking a step back, assessing what you own, assessing your portfolio goals, assessing what you want to do with your capital, and then trying to make a concerted effort. If you try to flip a switch and change something overnight, one could expect not such a great outcome.
Leslie, where can you come into those conversations on the redirecting your investment approach?
Yeah, so it's really interesting. In the energy access world, there's actually a number of oil and gas players involved. There's obviously people who have genuine curiosity for this sector. I mean, again, 1 billion people without energy access is 1/7 of the world's population.
And do we accept at this point, is it received wisdom now that they're not ever going to be connected to a grid?
Depends.
So some of them?
So if you take a place like Sierra Leone, grid extension could happen. It's going to take 80 years. Is that the right thing to do?
Yeah.
Or are there solutions that can be developed much faster than 80 years? Also, the reason why the grid doesn't go to these places is because it's expensive. I mean, a utility is going to look and say, we're not going to go there. It's going to cost $2,000 to connect a customer. Forget it. And that person remains unelectrified. So, the question becomes a natural curiosity. Are there mini grids that could deliver energy access with better economics?
And do the same people look at those as the people who might have done the grid? Are they looking to do a replacement, or do you have to come in some completely different person?
Utilities are complex beasts, and they're beholden to their balance sheets, and straying from the norm is not their strong point. Enter mini-grid startups, enter solar home system startups that are trying to just put basic solar panels on a home, and after it's a small system, but after 7 to 8 months, they've paid off the cost of that system, and then they own an asset. So we're talking about financial inclusion. I mean, there's real business opportunities here. You just need to have that patience, that curiosity to see where it's going to go, and that's why the oil and gas and electricity companies are poking around here. I mean, Engie, Total, Shell, they're all playing around. The question is, when are they going to get serious? And I think that's what
So if we look at just that particular question, where on the BS to reality are they?
I mean, the money they're pouring into this is not
nearly
nearly
as much
as
as
much
by
as
the way. I need to just ask everybody this in every interview forevermore.
I mean, when you put $5 million into an initiative within your company, is that serious when you're an oil and gas player? No.
Right.
We need to see, if you want to get really serious, we need to see 8, 9-figure checks going in just to really stimulate this market to get it to where it needs to be.
Mm-hmm. Matthew, so I mean, for all we hear that Leslie's saying that there's not enough being done in that space, actually that's one of the better known sort of alternative or the consequence of divestment from carbon producing sectors than other ones. So what else should we be looking at? What other areas should we be looking at?
And before I answer that, I just want to give a plug for Acumen, because I think a lot of the work that you've done with the patient capital has actually really helped foster both companies that have hit institutional scale and now have sort of become self-sufficient and actually attracted real commercial capital, spawned new investment managers building off of your track record, which also helps serve our clients, serve some of the stuff that WRI is trying to do. And so I think there's a really nice sort of ecosystem up here on the stage. I think there's a lot of conversation around energy and carbon emissions, but there's also, you think about climate solutions, it's a much more holistic holistic opportunity set and sort of world out there. If you start thinking about agriculture, built infrastructure, materials, water, obviously all of the resources that would fall under WRI. I think all of these are components. I think energy gets the most airtime, and maybe because it's the most tangible, or it's been such a focus area, such a heavy emitting sector. But I think there's a lot of different aspects to consider across the spectrum.
How can we get more awareness of that? Because I think you're absolutely right. I think people think that if you're talking about carbon, you're talking about the energy sector, as in people who produce energy, not necessarily people who use it or who emit carbon or degrade land or whatever.
That's right. I think it's getting increased attention. You think about a lot of the ancillary businesses, whether they're electric vehicles or new resource-efficient models, supply chains, thinking about this. Investors starting to think about and not just starting to think about it, but really having been thinking about this, how resource efficiency, energy efficiency, water efficiency all flow into company analysis, research, equity research from really starting to consider this. So I do think it's really coming to the forefront. I think energy continues to be sort of the leading sector as part of that conversation. I'd be interested in your perspective as well.
Yeah, I was about to say that. Andrew, do you want to come in there?
Well, I think you raise a very important point, which is we tend to think of carbon just as energy, but actually carbon is too valuable to leave up there. Our soils need carbon.
Yes.
And one of the very exciting things that's going on now is in landscape restoration. 2 billion hectares, that's twice the size of China. Used to be forest, and now it's really nothing. Has no value really economically. If you could bring back carbon in the form of soils and crops and trees and bushes, you would not only help the climate, you would double incomes in poor areas in Africa. You would make those crops more resilient. So, for example, there is something called Africa 100 million hectares to be restored by 2030. And since this is about impact investing, quite a few impact investors are sort of on the sidelines saying, yeah, we want to be part of it.
Who's running that project? Who's running?
Well, it's a group of us. I mean, the Africa Union is in the sort of head of it. There's now 23 African countries now committed 96 million hectares. We do all the mapping, we can show it's possible and so on. But I simply make this point because it's really important that we think about carbon holistically. Farmers are the managers of carbon, they need carbon. And so one of the things we've learned obviously about climate change is that we can't get to the 1.5 degree limit that we need if we simply reduce emissions. We have to also take carbon out of the sky.
Does that come into conversations at all for either of you? That that it's over just getting to 1.5 degrees by cutting carbon?
Yeah, obviously there needs to be a holistic approach, as we talked about in the last panel, and to all of the points mentioned on this stage. I think that's when you have to start looking at agriculture, the food systems that we talked about, water. And then the question really becomes, there has to be a role for government. Government has to step in to a certain point and play its role. Donor communities need to come in and play its role. Investors need to come in and play their role with returnable capital or wherever that's appropriate. And it's really about what's something I think so much about, and I think you guys probably do as well, is the right type of capital going to the right solution. Water, for example, and sanitation, very difficult sector to invest in. What is the right type of capital to stimulate this, to show that there is, or maybe never will be, market viability? And with agriculture, where within the ecosystem of ag are there solutions that are viable, tangible business models that can actually be scaled, but using the right type of capital to get there. And when the market's too fragile or segmented, making sure that it's more patient philanthropic capital, and those that are expecting returns can hold on a bit, but really roll up their sleeves when it's showing some market traction.
Matthew?
Yeah, I'm nodding my head because I think that's exactly right. I think the right type of capital for the right type of projects. When I think about our client base and the conversations we have, there's a lot of really cool things out there, but at the end of the day, our clients come to Morgan Stanley for their financial health, for their wealth, for their, to help grow their family, their family wealth and stability. And so it's about being financially rational with what you try to do. And the private sector obviously has a huge part to play in this, but to expect a financially irrational behavior because of 1.5 degrees or what have you, it is not. It's not something we're seeing today.
Questions from the floor for my panel. Do I have any hands up? So I have a lady here in a white jacket and a gentleman at the back there. If you could both keep your hands up so that they can bring a mic to you. Just say who you are.
Hi, I'm Jessica Brooks. I work at SunWealth. We're a small-scale renewable energy investment fund working here in the U.S. I know we've talked a lot about international. I'd be curious about the panelists' opinions on the Green New Deal and its potential to create jobs and create energy access, create savings, and just inspire a whole bunch of folks to invest in and work toward a future that benefits all of us.
Thank you. So I'll just take the other question as well, but it would be interesting to hear what people think about the Green New Deal. Yes.
Hi, my name is David Braham. You mentioned the right type of capital. Can you define what you mean? Are we talking about the right type of partners and what does that look like, or the structuring, or what?
Great. So let's start with the capital question. Do you want to talk about what might be right type of capital for?
Sure. I think, well, what I meant by it, and I can't speak for you, is sort of thinking about financially rational behavior and expecting when clients are looking for X type of return or risk or thinking about exposures within their portfolio, it is hard to think about, let's say, return-seeking capital as part of a sort of family wealth plan to all of a sudden try to do high risk, low return investing. There may be a part of that within the family system, but I think the point was that there's not a one size fits all for impact and capital, that it's not a one lane road. And so to think about what that means in the context of an individual or an institutional financial mandate.
I mean, you need some structured solutions, don't you, to allow so that the patient capital can unlock the less patient capital.
Absolutely, and I think everybody in this room has probably been part of conversations over the past 5 years ad nauseum about structuring impact and all of that. And I personally think it's less about structuring impact. It's not having to reinvent the wheel. It's sort of thinking about it in the context that people already think and assess, because that's how you're going to actually unlock the capital.
Do either of my other two panelists want to come in on that before we all opine on the Green New Deal, or?
That's going to be a long one.
Yeah, I thought we would leave some time for that. Green New Deal. Anyone willing to, yeah?
Look, if we're going to limit temperature rise to 1.5 degrees, we need disruptive, system-wide change across really all of the economic sectors. And that's not only energy, it's the way we do our cities, it's the way we grow and trade our food, it's the way we move from manufacturing to circular, and it's also our consumption. We're able to show that is possible economically and financially. And actually it's good for people. But there is absolutely and utterly inadequate leadership in the world to make that happen. Mm-hmm. So we have a problem. And without people power, we haven't got a chance of making it happen. And so the Green New Deal, just like the European process going on right now with, you probably saw this, a Swedish woman, a young girl, Greta Thunberg, that's sort of having strikes of students all across Europe and so on. Green New Deal is a wonderful thing. The Sunshine Movement is fantastic, because unless you have that people power, plus you have, the coalitions at the top as well, you're never going to get what you need. And so we're hugely positive about it. Does that mean you agree with every element of it? No, because some of their proposals, they don't believe in carbon pricing, it seems. That's not the point. The point is we need that kind of energy to drive politicians. And it's going to be very interesting. I mean, the last presidential election, the Democratic Party made a very clear decision: don't mention climate change because we'll lose votes. This time, they will mention climate change. Why? Because citizens are now overwhelmingly telling them we want to act. And by the way, why is it that so many Republican congressmen from Florida are now keen to act on climate change? Is because Florida is in deep, deep trouble, and they know that they cannot continue to lie their way out. I'm not saying they particularly lying their way.
Thank you for that.
Certain people. And that's why we're seeing a change. It's very exciting. This year, there'll be probably 3 bills introduced to congressmen that Republicans will sponsor. None of them will pass, but nonetheless, something's happening because people are demanding it.
And I looked to Andrew because of WRI's role in sort of catalyzing this knowledge, this information, really bringing it together. And on the Green New Deal, what I appreciated about it was the logic behind it in terms of actually using financial rigor to define some of the targets that we're looking for. And what was really neat about it is that you can take out the word green. In fact, if you present the proposal and sort of the overarching strategy, don't mention that it's coming from green, clean sources and all of the nuance that comes with it, it's a no-brainer, right? And then you add in what it is, it's this light bulb moment that finally the economics are starting to make sense. I mean, cost of solar, plummeting, and in a good way, and battery storage. And we're finally starting to see movement where the logic is and the numbers are really adding up. And it's, to Andrew's point, it's the time. I mean, it really. I mean,
I'd push back on both of you a bit. I mean, I think that leaving out carbon pricing isn't a detail. It's the thing that makes the whole thing fall apart, possibly, because it turns it into something that can just be about, directing capital the wrong way, spending on all the wrong things, not getting the impact that you should for the amount that you spend, tagging on every sort of project that you can under this heading of, it's going to increase jobs or it's going to increase something, investment, whatever. It takes away the rational process from the whole thing. I think that's actually a big problem, and I don't think that's something that can easily be retrofitted to it, because I think the reason it's been left out is a sort of a moral economy reason. It seems too precious to talk about the price of carbon, like emitting carbon is bad, you shouldn't be allowed to do it if you pay. And that is a fundamental issue. Our economics columnist who writes Free Exchange each week said that he fears the moment for economists to design a solution for climate change and to be listened to when we design a solution has passed, that economists have missed their moment, and now we're going to have non-economic solutions, which will by definition be less effective and more costly, with much more state-directed waste. So that was my jumping in there. I'm worried. I'm very, very happy about the energy and excitement, but I'm very worried about that particular direction to it. Matthew, do you want to come in on it at all?
I guess I would just say, as someone sitting up here on a climate finance panel, the idea of catalyzing focus and dollars to such an important issue is, I think, something that I think is exciting, and I'll leave it at that.
Okay, that's very, very tactful of you.
Very.
Anyone want to ask another question? Yes, we have a hand here. Thank you.
Thank you. Hi, Bonnie Lindy Bartok. I'm the founder of a company called the S Factor Co., the Social Factor Company. We do social factors and ESG. I've been in social impact for 22 years as a practitioner in operation across the world. I have a question for the panel on supply chain. Coming from field, I am challenged with climate finance as a whole. As we're moving in the direction of reduction of carbon emissions, we're replacing it with renewable options without fully understanding the supply chain of the raw materials that go into the production of renewables. So wind, solar, batteries, what have you. It seems the discussion went in the direction of whether or not we are providing energy for people who are not on the grid versus the scale and the urgency and the demand for the renewable energies and the investment in at such a global rate, where we're not talking about the level of mining of the raw materials that are required to fulfill that new scalable mandate. We've put some metrics around this ourselves, and the footprint, especially when you add the social vertical, which is the economics and the footprint on the cultures where you're sourcing the materials, is about 14 times bigger than what we're replacing in terms of the reduction of fossil fuel mining.
So have we got any sort of methodology that allows us to incorporate that upstream impact of batteries, and batteries in particular, the heavy metals involved are a serious issue?
I think you're raising a very important point, actually a broader point, that in our desire to do something that seems so obviously right, we need to sort of trace the implications, and obviously batteries is the most dramatic example, and obviously the Democratic Republic of Congo, and the alternative to that is actually deep sea mining, which is not necessarily the best, and there's a great important economist conference on the ocean in Abu Dhabi in a couple of weeks, and that will be one of the issues that's looked at there. So I think your point in general is absolutely right. And by the way, it applies in other ways too. I mean, you think about the environmental movement. Actually, we ourselves, if I assume everyone here is part of the environmental movement, you know, we're wanting to do things and we haven't thought through the human part of it. You know, we haven't thought through, you know, the implications for people. And I think there's actually a bit of a shift going on right now in really trying to understand what impact this has on real people. In many instances, it's positive. I mean, so for example, supply chains of palm oil, which is now a huge issue because it accounts for 3/4 of all the deforestation in Southeast Asia. It turns out the only way you can green supply chains is by paying attention to smallholders who have been neglected for the last 40 years, and they've got dreadful yields, and the big companies have terrific yields, and now we're investing a lot to help these guys. So it can go either way, but we do need to look at it.